Good afternoon, everybody. What a week this has been, okay? I guess with Nifty touching 20,000, the mood has been pretty buoyant, continues to be buoyant. We talked about a decade of India. It looks like multiple decades for India. We reached the 5th largest economy in the world, on our way to becoming the 3rd largest. We are currently, given all the headwinds all around the world, we continue to be the bright spot. Every indicator is positive, and I think the mood couldn't have been better. So in this backdrop, having this session on real estate financing and managing returns is interesting. And I do have a very interesting panel of people who manage a part of managing a large pension fund in India, Canadian pension fund. I have fund managers who are managing Indian high net worth money, as well as large Middle Eastern and other corporates, right? So the questions that I have I hope will be interesting enough, and we'll have answers which will be even more interesting, yeah? So, Chan, if I may, I would like to start with you. In fact, there has been so much of frenzy around logistics and residential of late, right? But if one were to look at the investments, especially the foreign investments, I'm talking about private equity investments into the country, office is something which has always found favor. And that was the case in 22. That's now in the case for 23 as well. We have, as of 23, first half calendar year, we have seen $2.9 billion come into the country, and the majority continues to be office. I am not talking about platform assets, but I'm talking about actual investments that are coming. So what according to you, is, what is your read on this sector, especially given what we are seeing on the office markets?
First of all, thank you, Lata, for inviting us, and NAREDCO for your kind invitation. To respond to your question, I think, look, office as a sector globally is a little bit of a bad word. However, I think, that's more traditional city center, front office. In India, as we know, it's more catering to technology campuses in 6 or 7 major metro locations. And from what I read, it's now proliferating to the secondary locations as well. And so I think from a medium to long-term point of view, we continue to remain long on technology-focused office. And we are not just saying it, we just put our money where our mouth is. We just invested $1 billion in a 12 million square foot portfolio earlier this year. And the reasons are very simple. I think, the macros and the fundamentals as far as technology talent in the country remains extremely strong. What has changed is the global macro environment economically, which is why discretionary technology spends have become much more selective. And I would argue that a lot of that spend that was going to third-party service providers is now being redirected to in-house, capability center type campuses. And I think there are sufficient examples that I don't need to talk about. India, at last count, is about 1,600 GCCs in the country. And I would stick my neck out and say this trend is likely to continue at a fair clip. And I would go even further that, as the dust settles, and if there is further rationalization on corporate spends, it's more likely than not that the CFO office, who becomes more active in such downturn events will ensure that jobs go to more efficient places where core activities that don't need to be in the home office can be moved. And coupled with that, this whole trend of artificial intelligence and machine learning and the whole value chain thereof is going to create a further differentiation in our view as far as India is concerned. That being said, we remain focused on the impact, the disruption impact of AI in general, on how technology spends are focused, particularly in the financial services sector, for example, where a lot of linear tasks are going to be impacted. It's not a matter of when, rather than not a matter of whether, it's a matter of when. And I think having said that, I think on the real estate side, my last comment there would be that over the last decade, that whole sector has been institutionalized. And it's another reason for us to feel more confident of bringing in further capital, if it makes sense, primarily because it's now controlled more by institutional players, be it domestic or global capital that's backing these asset management platforms. And that makes for better management of these platforms. And for us as institutional investors, as fiduciaries of pensioners, that's a very welcome development. I'll pause there.
A very succinct case for office development in the country and the investment for the same. I think, Vipul, I come to you next. I know you have kind of, in a way, mastered the debt strategy for residential spaces. My question to you is, given what you've heard on the office sector and the sentiment therein, what is your take on, or how do you think the debt strategies for office would evolve?
First of all, thank you. Thank you for calling me here, but I am in complete disagreement with what you're saying about master. See, I've done 2% of my job very well, which is deploying capital. 98% of my job, which is to get it back, is still pending.
I'm sure you will.
So I have done my 2% job well, and I think what has happened in the market as far as the residential market is concerned, at least I never expected, having spent whatever number of years in the industry, for it to bounce back so much. And I'll be surprised, and I'm sure there would be people who are on the ground, much more on the ground, who would have that understanding, but the bounce back has been significantly high. In fact, I was just talking to a couple of our fellow and they said, now the problem as a lender is that our sanction to disburse ratios are warped. So people are taking sanctions of 100 crores, but taking disbursement only 30 because the sales are doing well. And as bankers, we love giving money to people who don't need it. And people who need it, we stay away from them. So, but you asked about commercial debt. Personally, I am not a big, while that's my job, but I'm not a big fan of taking and giving debt at high cost. Because one of the biggest reasons why a lot of people lost in the last cycle is that they had taken high cost debt. The projects did not do as well as what they thought. And that debt starts compounding at a very, very fast rate. And a lot of people have been taking high cost debt, and obviously there were people like us who were ready to give also. A lot of people took debt in the expectation that I will make 3x. Instead of making 1.5x today, I'll make 3x tomorrow and blah, blah, blah. And life is not so linear, as everybody has understood. So on commercial debt, I don't know, Chan is the bigger expert. Sunil understands that segment better. But my take on this is that given the global situation and the fact that irrespective of what we do, given the global situation, given what is happening on work from home, given what is happening on the fact that there are about 16 to 17 large commercial platforms that at least I know of that exist, and coupled with the fact that I can actually do a ground up building in commercial in 2 years flat, thanks to tech and prop tech and construction technology and so on and so forth. I think, and the biggest, and the last, probably that the biggest enemy has been the infrastructure sector for commercial. Prime real estate is no longer prime. Roads are being built, highways are being built, some bridges coming here, some bridges coming there. So what you think is super prime may not be super prime 2 years later. And that, so that so-called location advantage will be lost. So if I'm like, we as an organization were looking for space very recently, we didn't find anything in south of Bombay because there was nothing there, but it's kind of difficult. And one of the reasons we did not do it is because we said, let's just wait for all these infrastructure things to happen and maybe take that call 1 year later. And debt, commercial debt you mentioned, I am assuming it is because there are enough foreign funds who are now coming and talking about doing, what is that term, forward purchase. So they say, I'll buy this at a X price, but you put the money. Now when that developer, poor chap, when he has to take that money, he goes and buys the land, okay, fine. But then what does he do about construction? So if that is the debt you're talking about, I will not do it if I'm a developer. I don't think it's a good idea. I would rather sell it at a slight discount. I would rather, if I'm big enough, I will go to a bank and take a 10, 11% debt, then it's okay. But a bank will say, I want monthly servicing. I'm sorry, but I'm not sure if I'm asking what you're asking, trying to ask, but no, I would not take, yeah. I would not encourage that you should take too much debt, whether it's low cost or high cost, in commercial, given the fact that the macros are not so as certain as they are. So you should be careful.
Okay, Vipul, thanks for that. Sunil, the question to you is on, I think this where I would want you to put your hat of what you have done over multiple years, okay? With the kind of mood that exists on residential real estate, and especially with the spate of new launches that come in, what I wanted to check with you is how do you select projects that are well positioned